Thank you very much. My name is Foster Wright, and I'm the president of CoinDesk. And it's my pleasure to be here today to moderate this panel on stablecoins with a fantastic group of experts. No doubt we could spend hours, if not days, covering this topic. I think that the previous panel already touched on some of the issues that we want to address, but given we have such a short amount of time, I'd like to just dive right in and get to the core of some of the questions. But before we do have the questions being asked. If you want to go old school and just raise your hand, happy to have you just shout out the questions. But why don't we start by just having the panel introduce themselves, who you are, your firm, and ultimately how you sort of engage with stablecoins. Nicola?
Sure. So Nicola White, I'm the CEO of B2C2. I would dare to say we're the largest or one of the largest OTC liquidity providers in the space. So we use stablecoins to settle when banking rails, I guess I would say, are limited to 5 days a week. Well, most of them. We use stablecoins in that respect to settle with our clients on the weekends. We also use stablecoins as on and off ramps for a lot of our clients. So we facilitate quite a lot of stablecoin flow. Luckily, we never participated in Terra, so we've stayed on the safe side of stablecoins over the years. But yeah, lots to talk about in that space.
Awesome, Matt.
Hey guys, Matt Ballenswag. I'm a managing director and head of Go Network at BitGo. For those that don't know, BitGo is an institutional-focused digital asset custodian. We're based in Palo Alto, but we have offices globally. My role as head of Go Network is to really kind of increase the utility within the qualified custodian. And so what I mean by that is really kind of reactivating assets that would otherwise be kind of dormant, sitting in cold storage. So how do we connect those back to the market? And so thinking about things like 24/7 settlement, which would be obviously supporting both stablecoins and fiat, and then also the ability to kind of utilize assets that are held in cold storage for trading purposes on exchanges, and that would also be both stablecoin and fiat as well. So we're obviously custodying a host of different stablecoins. I would say USDC would be the primary, but we see the full gamut.
Awesome.
Hi everyone. My name is Chris Harms. I am co-founder of BVNK, the host this evening. We use stablecoins and help businesses to access basically faster and more efficient payments through stablecoins.
All right, good deal. So I guess in talking about stablecoins and crypto in general, there's so much attention and interest in providing examples of good use cases. Can you, I guess from each of your own perspectives, talk about who benefits the most from stablecoins today? And are there real-world examples that you think are driving real business value ultimately for institutions or for consumers?
Yeah, so I mean, I would say who benefits from stablecoins? Well, so we benefit from weekend settlement, right? So on a weekend, like 2 weekends ago, when the market moves quite a lot, one of the ways in which we can reduce our exposure is to settle with our clients on the weekend. So instead of extending really large limits to our clients, we'll extend smaller limits and we'll ask them to settle with us 24/7. So that allows us to keep credit lines, I would say, at a respectable level. So we're not overextending credit to the market. That's good for us. It's good for our clients. And really, the key to that is being able to settle, 24/7, 365, which stablecoins allow us to do. The other thing I would say is we do have quite a lot of clients who don't have access to banking rails or an abundance of banking rails, right? And I think this year really showed it in the events of March, where we used to think that having $2 or $3 banks or €2 or €3 banks was enough, and we quickly determined that the right number is probably somewhere in the 5 to 6 range now. But I do think that stablecoins offer an alternative to the banking system, and then I think you can also even almost bridge stablecoins into tokenized money market funds. And what is something that stablecoins haven't been able to solve up until this point is addition of yield And as yields get get inflated in the U.S., people are looking for returns on their dollar or their currency reserves. So how do we think about combining all of those? I think is something that the market is just starting to wrap its head around.
Absolutely. Matt?
Yeah, I would say, I mean, there's no doubt, very real use cases for stablecoins today across the market segment. I think all stemming from the fact that there's inherent utility in stablecoins, and I think everybody in this room can agree on that. So, philosophically, right, you're getting an asset that has stability in that it's pegged to a dollar, but you're getting these, inherent properties of digital currencies, right? So it's globally accessible, right? There's no boundaries or intermediaries. It's programmable, and that can be used in both smart contracts, obviously for DeFi, but can also be exchanged via centralized exchanges as well. And it's just cheaper and more efficient. So I think from a philosophical perspective, there's obviously utility, and then it's like, where in the market do you see most of these real world use cases popping up? I think the clearest picture is just on the institutional trading side, which I'm sure Nicola can talk to as well. But obviously, if you just look at a lot of the most liquid trading pairs on the exchanges, it's BTC versus USDC or BTC versus USDT. So they do provide a ton of liquidity globally. And then on the decentralized exchanges as well. So obviously, if you have USDC, you can go in and out of USDC and Ethereum via applications like Uniswap. So from a liquidity perspective, I think obviously for financial markets, it's a very obvious use case. And then outside of that, I think there's to Nicola's point as well, a lot of our clients globally find it more efficient to use stablecoins to actually go in and out of their local currencies into US dollar. And so we see folks in Latin America or even parts of Africa using their local currencies to buy BTC or ETH, swapping that into USDC, sending that USDC to BitGo, and then using that to convert into US dollar at 1-to-1. And that life cycle is actually more efficient and cheaper than the existing international kind of remittance rails today. So I think that's another use case. And then lastly, I would say we're starting to see kind of this concept of bringing real world assets like money market yields or bonds on chain to be used as collateral as well. And so I think there's going to be a lot of development in that segment as well, where you get these stable assets that are actually really utility driven and yield providing that could be used from a trading perspective.
Yeah, so I think we've had a very good vantage point over the years where we've seen a bunch of the consumer and the B2B use cases develop. Initially, as we started out, we were using stablecoins as a replacement for SWIFT effectively. So we would rip out the SWIFT network, stub in a blockchain, use stablecoins on ramp, move the money off ramp, settle. So that proliferated quite quickly. But as we started doing that, we saw more payment processors and these sorts of merchant acquirers come in, and they started receiving stablecoins as a way to settle from their global partners around the world who were doing card processing for them. So you saw all these use cases originally kind of pop up, more efficient payment rail, then I can use it as a settlement currency, get back into fiat. Now we've started, to see, on the other end of that, where merchant acquirers are actually trying to settle their end merchants in stablecoins. So it's just, again, that two sides of that same more efficient settlement infrastructure. And then to Matt's point on the remittance side, given, we like I said, had a good vantage point on where all these payment companies were. We have some remittance businesses as customers, and they're very much serving that B2B2C use case where it's just more efficient for someone to use a stablecoin rail, get into crypto, move that into an emerging market, and a lot of the time the last mile payment becomes the pain. So you just switch that into stablecoin, and that local consumer is willing to receive a digital dollar versus their own local currency as well. So I think the use cases are real, the adoption is real. You can just go look at some of the chain analysis, adoption of crypto, reports and that sort of thing. So, yeah.
Yeah, I mean, I guess, Matt, could you, a follow-up question on the utility at the consumer level, emerging markets versus the US, just what you're seeing in markets like in Argentina or Turkey?
Yeah, I would say obviously in regions that are emerging like Latin America and parts of Africa, that's where we really started to see the early use case of stablecoins. And there's companies like BitPeso is a good example of a company that was very early in the space that focused on kind of African regions, being able to utilize BTC really as the conversion layer. But that is really where I'd say most of the demand is coming, at least from like a cross-border remittance perspective, is in emerging economies. I think in the U.S. there's more of just an ease of use, right? Like it's highly accessible. It's 24/7. Institutional trading firms in the United States are not like waiting for banking rails to open on the weekends to Nicola's point to settle. So they're different use cases, but I think they're both very relevant to what's actually driving the demand and adoption for just stablecoin transactions generally.
Okay, great. So despite the growth and success overall of stablecoins, when you look at the total landscape, at the end of the day, they only account for a small portion of the global payments market. Aside from regulation, what are the sort of key blockers? I don't know, Nicola.
I would say definitely, I mean, we saw it in March, right? I think there is this thought that, okay, what happens when a stablecoin depegs, right? Is there transparency and visibility into the stablecoin? What are the chances that when banking rails open up on Monday morning, that I'm actually going to get that dollar, right? And so should it trade at 1-to-1? Should it trade at 98 cents? I think that's really what was called into question this year, and that's really where you saw stablecoin volumes kind of pull back pretty significantly. And I think the one thing that we need to work on as an industry is, okay, well, now you have 24/7 stablecoin settlement, but you're still constrained by traditional banking rails if you want to convert that to dollars. And so are there people that can step into the space and really act as a 2-day buffer or a 3-day buffer over a holiday to kind of, I don't want to say hold the peg, right? But if you have transparency and certainty that a stablecoin is backed 1-to-1, you feel pretty confident stepping in and taking that 2% difference, right? If you don't have that visibility and you don't know where things are, I mean, it's anybody's guess as to where things can trade, right? And so we always say, there's not, like when we're going into a weekend and there's financial instability, there's no chance that a stable coin is going to $2, but it could go to 30 cents on the dollar if we don't have that transparency. And so we think a lot about, from a stablecoin perspective, what's their most recent proof of reserves look like, proof of funds look like, how confident are we about the banks where they're holding the assets, right? Because not only do you have to worry about them being backed 1-to-1, unfortunately, and I'll date myself a little bit, right? I went through the credit crisis, and the banking system is not as secure as we once thought it was, and that is just a fact that we need to deal with and we need to price into our models. I remember when I was trading treasuries, we had an 8 basis point credit spread for Eurodollars. And we spent, like during the credit crisis, we ripped that out because credit spreads were no longer at 8 basis points. It's the same thing with stablecoins. We need to have transparency, but then we also need to have certainty as to where those assets and those reserves are being held.
Great. Pat?
Yeah, I would say a few things in terms of what the barriers are, but I do want to acknowledge too that despite it being a relatively small part of kind of global transaction volumes, that these are, they're very real markets. You just look at the crypto market cap alone, right, which is over $1 trillion. Stablecoins represent, from a TVL perspective, roughly 10% of that. But even more important is kind of the velocity at which they power the ecosystem. I think they make up roughly 70% of all of the on-chain transaction volume across the ecosystem. So very, very relevant in terms of how capital's moving. So it is, relatively nascent stages, but almost not really. But that being said, there still are, many real barriers to, I'd say, an even bigger kind of explosion of stablecoin commerce. One would be just right now, even in this kind of market environment, would be the opportunity cost of actually keeping cash in stablecoin and not being able to actually generate yield on those stablecoins in an efficient manner from a trading perspective. If you think about traditional markets, right, you can actually leverage your T-bills or your government bonds as collateral to trade via your prime broker. And so you're getting the yield benefit of holding those securities, but you're also able to use them from a capital efficiency perspective. That's not really being implemented right now in the space. There are companies that are actually looking to solve this. So if you look at firms like Ondo Finance, they're trying to bring money market products on chain, and they've created an asset that inherently basically pays that yield called OMMF. They also just launched USDY, which is a government bond-backed stablecoin. And so the challenge will be, can we utilize those assets as collateral from a trading perspective, and can we implement that? And there's other companies obviously trying to solve similar problems. And then BitGo, it kind of sits in the middle of the ecosystem where it's, can we be a shepherd and actually take those native yield-generating assets and empower institutional clients that custody those assets at a qualified custodian? Can we make it seamless for them to actually use that collateral to trade across the space, to settle with their counterparties? So those are some of the barriers that I think are actively being solved. And then I'd say, like, a little bit more futuristic is, I'd like to see just like the actual programmability use case expand a bit. Like right now, it's like, what are the real examples that come to mind from a programmability perspective and smart contract perspective that actually has some legs is, borrow lend protocols like Aave and Compound, and those are pretty active. There's about 8 billion of total value locked on those platforms today. So recreating kind of this borrow lend marketplace that's totally permissionless. But it's like when you think back to early days of the internet, you probably couldn't fathom that, you could go on your mobile device and via the internet call a car to come pick you up, right, and take you wherever you want. It's kind of the same thing. It's hard to even project forward like what those applications will look like. But I think we need to see some more tangible ones for stablecoins to actually really continue to blossom.
Yeah. Chris?
Yeah, well, obviously regulation is the big one, and I agree with the points that Nicola and Matt made. But I would say actually the concentration risk in dollar-issued stablecoins is actually like the world's global reserve assets are about 58% dollars. Stablecoins are 99.2% basically dollars. So if you have some more locally issued stablecoins, there's a Sing dollar one, there's a Euroc, and more of those start trading, you can start getting into more different some of these remittance use cases we were chatting about earlier. But you do need a local stable issuer that can provide that one-to-one in the local market with some sort of standardized kind of issuer body. There's the stablecoin standard industry body that just launched. Like, what does industry guidelines look like for a stablecoin issuer? Some of the big guys haven't joined just yet, but I think that's a good development. And all those are positive, like hindrances. But if we can solve some of those, I think you'd see it positively move forward.
Got it. Okay.
And then I think it opens up a world of like, can you do CAD dollar on the weekend through stablecoins, which is really interesting because right now we just accumulate that over the weekend and then look to hedge it when markets open up on Sunday night, but that's not efficient.
Right.
Exactly.
And is there a world where we have, say, a brick stablecoin or non-US dollar, the growth continues outside of the US dollar ecosystem?
I mean, I think there's an interesting case, like how does the yield get generated, and if the yield is still being generated based on like where rates are in the U.S., is it truly like a self-sufficient mechanism? I mean, there are interesting projects out there that are trying to generate yield on stablecoins from the actual securing of the networks themselves. There's an interesting company called Athena Labs that is creating a stablecoin where you can basically the way it actually functions is. People will deposit USD or USDC. That will be used to buy ETH. Then there's obviously the ETH will be staked to generate some sort of staking return. That's the yield functionality. But then you're thinking, oh, but now I have this delta risk to the price of ETH. But then what's actually happening on the back end is they're hedging out the long ETH exposure with short perpetuals on a variety of different exchanges using platforms like a Go network at BitGo or a Copper Clearloop to not have to take the exchange risk. And so you have this perfectly basically stable asset where you're long spot and short future that's actually yield generating based on the staking return of the ETH. So it's an interesting concept of kind of powering yield via non-US dollar kind of dependent mechanisms.
Got it.
No, I mean, look, I think the one thing that, especially when it comes to yield in the US, it puts you squarely in the realm of the SEC, which a lot of people don't love, right? So doing something offshore in the ETH space is really, really interesting. And I think that there's lots of use cases like that, right? Like, and I'm not saying there's a use case where we're trading under the SEC's regime and we're getting yield in the US. I don't think that the SEC has been, they've definitely been more open to that space, but there's not like, this well-defined path, right? Everyone's kind of going to them on an individual basis and hoping that they get approved. But then there is also an outside of the US world where you have a lot more flexibility and you can do things like ETH, you can do interesting things like emerging markets and things like that. But we're still feeling out the dollar space and hoping that we get some more interesting things offshore too.
Okay, great. Visa recently announced it's expanding stablecoin settlement capabilities to merchant acquirers WorldPay, Nuvei. With Visa planning to leverage the Solana chain to increase transaction time and reducing fees, What do you think this means for the broader payment industry?
Maybe I'll kick off with that one. I think it's a it's testament to basically Visa rubber stamping stablecoins as a settlement mechanism in their kind of settlement network, because you've got issuers. If you think about how the money flows, it goes from issuer, someone spends with their card, it goes from issuer to Visa. They've got a massive treasury, and then it gets to a merchant acquirer, and then merchant acquirer settles the merchant. That happens all, very quickly in terms of messaging, but there's a huge treasury operation that happens there, and it's an absolute nightmare for issuers and merchant acquirers to deal with Visa. And, they're Visa, so they don't really care about that, but they've unlocked this new 24/7 settlement rail, reduces pre-funding for a lot of issuers. So I think it's a very interesting use case. MasterCard have actually got the same pilot going on. They just don't make as much noise about it, but you can see it. I think it opens up a lot more volume. That stablecoins could really be used for, and it really does rubber stamp, stablecoins as a settlement mechanism and a layer to do payments. So.
And I think we've seen that trend in stablecoins all year, right? So if you look at, let's say pre-March, right, there was a lot of volume going through in fast banking rails, and then we quickly saw a switch to, okay, now we're going to do some more stuff in stablecoins, and shockingly enough, maybe not stablecoins that were as transparent as others, because people didn't want to be seen as trading like very regulated US-centric stablecoins. But the other trend that we saw was prior to Silvergate and Signature, most of our stablecoins were settling on ERC20. And now most of our stablecoins settle on the Tron network, and we're seeing a lot more stuff come out with like USDC on Solana. But there has been just a massive shift to low-cost chains away from some of the higher-cost chains, because people want to make them more part of their workflow. And so we actually saw quite a few clients switch from trading like Bitcoin dollar pairs to trading Bitcoin circle pairs or Bitcoin tether pairs, just because it was so much more low cost once there was that unavailability of banking networks.
Got it.
Yeah, I mean, I think Visa's been at this for a while, right? I remember they did their first pilot with, I think it was like Crypto.com's credit card back in 2020 or 2021, and that was on the issuer side. And so, it makes a lot of sense that they're looking at this on the merchant acquirer side, which obviously then trickles to the merchants themselves. I mean, I think, what does it say for just the general payment space is, it's incredibly validating to like the cross-border kind of remittance use case of USDC specifically, but also just public blockchains like Ethereum, Solana, and others. I think it's also kind of a signaling of like it's game on, right, in the payment space. It's the most innovative companies are going to win, and if public blockchains can provide that settlement rail that is more efficient and more cost effective than the current system, then you're going to see a lot of exponential adoption of those mechanisms, and good for Visa for obviously kind of taking the pole position there. I think also what else, like Visa might probably explore other blockchains to Nicola's point, like whether it's Solana, which obviously they're exploring currently. Maybe it's Ripple. Maybe it's other high speed blockchains. And then who knows? Maybe they explore trying to own the whole vertical and start some sort of private blockchain that's just Visa's blockchain. So I think there's a lot of ways this can twist and turn, but I think the most important point is that it's incredibly validating for what we've been kind of talking about as an industry for years now.
Yeah.
To see this mainstream adoption at the remittance level and not just the speculation level.
Got it. Okay. Got a couple questions here from the audience. Do you see any potential in using stablecoins in card issuing and acquiring settlement flows?
No, I mean, I think you've seen a lot of issuers run, a lot of crypto native issuers running crypto card programs. Visa runs one, MasterCard runs one, and that's really just, retail crypto platforms giving their customers the ability to spend crypto. But at the end of the day, that crypto is still being settled in fiat to Visa. This is not taking that one step further and opening up. It could truly be spent in crypto and settled in crypto, which changes the game. It changes the game slightly. So I think definitely you're going to see an increase in kind of issuing programs that change from you're actually not really spending crypto. You're just spending crypto, gets converted, you're settling fiat, but the whole end-to-end flow can now go from when it's spent, when it's settled to Visa, and when Visa settles it on the other side can stay in crypto. And I think that's pretty powerful.
Matt, I don't know.
Yeah, no, I agree with that sentiment generally. I think anytime you have the on-off ramp is when there becomes inefficiency. And so if you can, go end to end on the stablecoin side itself, that's when you can really change the game and level things up. So it's great to see, I think, Visa specifically, they've done the pilots with the issuing side where they're getting paid in crypto. Now they're starting to pilot on the merchant acquiring side where they're paying out in USDC on Solana, right? And so the whole end-to-end is more efficient. And I think, to your point, that's kind of the end state.
Okay. Here's an interesting one. What is the role and utility of stablecoins in a world where CBDCs are more prolific?
I mean, I'd love to say that we're close to CBDCs. I mean, definitely in emerging markets, we're closer. But I mean, I think in any of the major currencies, you're still a couple years off. So what's going to happen in the meantime is, private stablecoins are probably going to take that place. And I think, to Matt's point, it's all about utility, right? It's how quickly can you build utility from consumer, the OTC market, the exchange space, right? And once something becomes sticky, it's a lot harder to unwind. So I guess my view is that we probably don't have the 3 or 4 years it's going to take to get any kind of CBDC into the space, and stablecoins are going to become pretty sticky because they're efficient.
Yeah, I think you probably got to look at the model of CBDCs. They've been trialing two. One's really a retail-driven, direct-to-consumer CBDC, where the central bank, you have an account with the central bank as an individual. I don't think those happen. And then you have probably what happens is how the kind of banking system works today, with the commercial bank facing a central bank and using CBDCs more as a settlement mechanism interbank. I think that use case is being developed. But yeah, I think the retail side, a lot of people looked at that, but effectively you remove commercial banks from the whole picture, and I don't think they want to remove themselves from the picture there. So
Yeah, no, I would agree with that. I think we're probably years away from that market structure developing. That being said, it's obviously something that needs to be kind of considered. But I do think, right, when you think about that, that's government bank versus commercial bank, more from a settlement perspective. I think that still leaves room for more retail-oriented stablecoins like USDC, especially ones that have significant market share today, to continue to really be like the utility-driving stablecoin. I also still think that leaves room for USDC to be the stablecoin of choice for institutions from a trading perspective. It's all about, I think a lot of it is about the starting point and just like the time to market and how interwoven you are into the way that those financial markets work. It's going to take time for CBDCs to actually permeate through. Doesn't mean they won't serve obviously tremendous value later on, but I think that the way our financial markets are working in crypto today, people don't like change that much, and so it's like if you can integrate now and really be like a thread of the fabric, then it's going to be really hard to displace those currencies. So I actually think that like USDC, for example, is going to continue to grow in market cap significantly as the space does and evolves. But that being said, obviously there's room for market structure changes, and there will be market structure change.
Got it. Okay. What do you see as the relative benefits of less regulated stablecoins like a Tether from both a current market demand and long-term perspective?
It's a tricky question.
I mean, I could start. I think Tether's what's kind of gotten this all started in one way, shape, or form. From a current, accessibility and inclusion perspective, I mean, Tether is the stablecoin of choice outside of the U.S. and its market cap is 4x that of USDC. Like, it is a global stablecoin, and despite all of the uncertainty around how that treasury is managed and the lack of transparency around it, it still represents a huge part of the way that money moves throughout crypto today. That being said, I do think we're moving towards an environment where processes are going to be more scrutinized, where regulation really matters. And so my hypothesis is that assets that are regulated but still as capital efficient and accessible will take market share methodically and systematically from Tether over time.
Tether has this weird status in the market. Like when we were going through the events in March, everybody was like, "Oh, I'm gonna go out of Circle because they're regulated in the U.S. and I'm gonna move into Tether." But Tether still holds dollars at banks that are U.S. banks, and if the U.S. government ever decided that it wanted to rip I don't think this would happen, but to say that it's not exposed to U.S. regulation, I think is very naive. But that thought does exist out there in the world, that, you know, if the US government all of a sudden thought that Tether was involved in sanctions and they wanted to seize those dollars at US banks, they could, right?
Yeah.
But for some reason, people just don't associate Tether with US regulation, and it's I don't know how, but it is kind of like escaped this like thought that it is in any way joined to the US.
Got it.
I mean, I think the fact that Tether, despite all the fight and everything around it, is still being used in this 4x out of USDC just shows the utility of stablecoins within the whole ecosystem. That despite everything all around it and its perception of being a less regulated stablecoin, it's still heavily used in the in the ecosystem.
Okay, we are out of time, but one last question for you, rapid fire. Whether you have a prediction or an expectation for 2024 that would move the market forward in a positive way. Any thoughts?
I would say, you know, the joining of stablecoins and tokenized money market funds, I think, is a huge trend that we need to focus on, especially with yields where they are.
You took the words from my mouth. The rise of you know, native interest-bearing stablecoins and then the shepherding of those as assets to be used as collateral to decrease market structure risk but increase capital efficiency in institutional markets.
Yeah, I would say 2022 was almost like a watershed year for crypto payments, and that use case is, if you look at charts of active users of stablecoins, I think it's like 5 million weekly active users, 25 million, you know, addresses on chain across stablecoins, and I think that has just gone up and to the right despite the rest of crypto kind of melting down last year. And I think that trend continues into 2020, you know, back end of 23 and into 24.
Great. All right. Thank you.
Thank you.
Thanks.